Good morning, everyone, and Happy New Year. I'm Emily Drake, partner and advisor with Fairport and Luma Wealth. We hope you and your families are healthy and happy, and we welcome you to our first investment town hall of 2021. As a reminder, based on your feedback, we've scheduled these webinars on a quarterly basis. Besides being here today, you can connect with our investment team through timely email updates. You can subscribe to the Fairport Flash podcast on Apple Podcast, Stitcher, or Google Play, or you can follow the hashtag Investing with Fairport on LinkedIn for weekly thoughts on the market and economy. As always, I'm delighted to be joined by our Chief Investment Officer, John Silvis. John and his leadership group have prepared a presentation, including a brief overview of last year, some economic and market themes for 2021, and how our team is positioning portfolios. Some of you sent some questions in advance. One such email referred to our town hall webinars as always informative and described me and John as individuals with brilliant minds. You can be assured we will do our best to address all of his questions throughout our presentation. General housekeeping, everyone is muted for this webinar, and as much as we'd like to see your faces, your cameras are disabled. If you do have additional questions, feel free to type them into the questions toolbar, and we'll answer as many as we can, time permitting. So with that, I will turn it over to Fairport and Luma's Chief Investment Officer, John Silvis.
Hey, Emily, how are you? Happy New Year.
Thanks, John, you too.
All right, so let's get started. We got a lot to talk about. So 2020 has been quite the year. Good to say goodbye to 2020 and say hello to 2021. As you can see here in the cartoon, a little bit light humor, but if there's one thing we're probably all fixated on going into the new year, it's the vaccine, the vaccinations, and distribution of and how we get them. Actually, I went on the CDC website yesterday, and we've had 3 million people been receive the vaccine. So we're making progress. I think if you remember last year, we talked about one of our main themes that we'd have a vaccine sometime in 2021. So as far as I'm concerned, this is a good thing. We're ahead of schedule, so that's good. So I thought we'd start off a year in review. Quick, kind of talk a little bit about 2020. Where we ended the year. I would tell you it was quite the ride. And as we all kind of know, and we look back, we'll talk a little bit about some of the highlights and I guess the lowlights too. So first, from a market standpoint, 2020 wasn't a bad year. In fact, I know, the human story of 2020 and the pandemic was awful, and I think it's something we're all trying to come to grips with and move forward with. But from a market standpoint, it wasn't too bad. Hopefully, you can see my cursor here. So if you look at that third column from the right. Small caps actually outperformed in 2020. Really, off the bottom in March is where we saw most of the performance in small caps, and they rallied into year end. And that's one of the themes we'll talk about going into 2021. Emerging markets also outperformed, and then large caps came in at 18.4%. Now, I know at the middle of March when they were down 35%, who would have thought we'd see a rally of over 65% in the last, I guess, 9 months of the year? But so far, that did prove true. And then even on the fixed income side, if I can find my cursor, there it is. Fixed income, which is that kind of grayish blue box there, came in at a little over about 7.5%. So overall, it wasn't a bad year from an economic or from a market standpoint. Volatility was well above average, matching past recessions. So we did have a recession, although I think it was brief. We saw a correction of about 34%. As I mentioned a few seconds ago, in 2020, if you go back and look at past recessions, 2009, we saw 28%, and then even back in 2002, we saw around 34%. So in the big picture, it's kind of right in line with what we've seen in past recessions. But we had a correction pretty much in every quarter last year. So when we talked a little bit, one of our themes last year was we're going to see increased volatility in 2020, and that actually did come true. In the first quarter, as everybody knows, and that's the big one, was 35% decline. We saw, I think it was a 9% decline in the second quarter, 10% decline in the third quarter, and I think an 8% decline or 9% decline in the fourth quarter. So wasn't a dull moment, and we saw a little bit of a bumpy ride, but if anything proved true, is just to be stay invested. So as we finish 2020 and as we transition to 2021, the trends look pretty good. This is a chart from Strategas Research on the technical side. The top part is the S&P 500, and as you can see, with the exception of the big decline last year, we had a pretty good year. Markets are definitely in an uptrend here. This bottom part is the percentage of stocks in an uptrend. So basically meaning they have a positive 200-day moving average, which is how we kind of define trend. And history will tell you when you're at these numbers, you would think that the market's oversold in a big way, but it's actually usually viable, especially if you're looking a little longer term. So I think that's one of the tailwinds we're going to see as we head into 2021. So I'll pause there for a second, Emily. I don't know if you want to start with the questions now or you want to go into the economy, but I'll pause here.
John, it doesn't look like we have any questions yet, so keep going.
Okay. Well, one of the questions we did get from a caller or from an email was, what's our thoughts on the economy and, what really does drive the markets or drive the economy? And I think the big picture is, and we'll go through some of these slides in a second here, but really our view has always been that the economy drives the markets, or at least the economy drives earnings and earnings drives the markets. But I guess if you took it one step back, it really is the consumer that drives the economy. And I think that's where we're seeing a lot of the resiliency recently. I would say about 80% of the economy is open right now and doing well, and 20% is still struggling. We'll talk a little bit about that. But I guess to answer the first question, it's really, being about 70% consumer driven, the consumer really is the driving force of our economy. And as the consumer goes, so do the markets really. So we set out this year, like we have in years past, and looked at economic themes and market themes as well. And what are we looking at going into 2021? I think we actually sent an email out, so you may have seen these already. But really, the first and foremost one is something we talked about last year at around the election time. Is we think the economy is at the beginning of an economic expansion. In fact, I'm more convinced of that now than I was a few months ago when we spoke. But we expect GDP trend to be above long-term trend. So that's one. We do think there's going to be more stimulus coming. In fact, when I wrote this in the second day of January, I wasn't as sure with the outcome of the Georgia Senate runoff elections. Democrats getting a 50 seat, I wouldn't call it majority, but a 50 seats in the Senate, with the tiebreaker being the vice president coming in, Vice President Harris. We think we're going to see at least one more stimulus package, and I think the Biden administration is pretty committed to that. I think the Fed's going to hold off on rates, and we'll talk a little bit about that as well. And then we think the dollar will probably continue to decline, not because of a negative connotation, but we just think because the economies are growing both here domestically and globally. So as far as looking at, I guess, the last piece of 2020, which is the fourth quarter GDP number, which is not out yet. We'll see it, I think, another week. GDP growth should be well above trend. We think it's going to be above consensus here. This is the Atlanta Federal Reserve's GDP Now survey, which we've talked about several times in the past, but it's been very accurate. It's forecasting about 8.7% GDP growth in the fourth quarter. The blue chip consensus, which is a makeup of most of the Wall Street economists, are really looking for somewhere around 5% GDP growth. So I think we're well above the consensus, probably closer to the 8%, which is a great way to start off the year. Unfortunately, we still have a lot of people that are unemployed. At the end of the year, we had 5.1 million people apply for unemployment insurance or unemployment claims. And, that's unfortunate. We saw the peak at 25, so we definitely have been working down. As I mentioned earlier, I think it's kind of the 80-20. 80% of the economy is doing really well. I think the 20% that's still struggling is mainly those service sectors, restaurants. Depending what state you're in, a lot of restaurants are still closed. Obviously, movie theaters, live events, cruise industry, those type of things are still just struggling. And I think until we see that economy reopen in the second half of the year, driven by the vaccine and the people getting inoculated, it's going to be a struggle going forward. But I think we're heading in the right direction as far as the economy goes. The V-shaped recovery theme that we've talked about, I think will continue in 2021. This is the ISI, excuse me, ISI's company surveys. We talk a lot about this. It has a great indicator for future growth of the economy. It's been very highly correlated, so it's something we keep close eye on. The most recent data continues to climb. It's back up above the 2018, or back up towards the 2018 numbers, and is forecasting, if you look at it from a historical standpoint, probably around 3% GDP growth going into the first quarter of 2021. We think we'll actually see better than that. Again, the V-shaped recovery continues in the trucking survey. It's a good indication that people are out there moving goods and services from one end of the country to the other. So again, it's the highest that we've seen since 2005, and I think that's another tailwind that we're going to see moving forward. Composite, I'll speed up here a little bit, but the composite PMI numbers, again, going back to a 2015 highs. So I think, the economy is, as I mentioned earlier, is beginning the expansion. I think the expansion is taking hold, and if history is any guide, usually about economic expansions last on average about 8 years, anywhere from 5 to 10 years is the long-term average, and we think we're going to see that go forward. And equity markets tend to go in the same direction as the economy. So I think as the economy improves, we'll see further upside in the markets as well. But despite the rise in cases, and this kind of goes back to people wanting to get out in part of the reopening, air travel is still picking up. In fact, this number here, if I can find the cursor, there it is going back to the end of December. And if you look at the end of December, Christmas time, people were traveling. In fact, it's the highest we've seen since March 15th, which is really right about when we shut down the first time. So despite the case numbers and despite the increase in cases, people are still choosing to travel. It's well below where it was pre-pandemic levels a year ago, but definitely showing some signs that things are getting better. And I guess the last thing is, from a global standpoint, I got a few more here, but we'll talk about interest rates. But from a global standpoint, is the dollar continues to decline. And usually when you see weakness in the dollar, it could be a few things, but in this case, it's because the global recovery is picking up. And a couple of things are beneficial when that happens. Usually when the dollar declines, our exports, meaning our goods that people import in other countries, tend to be more competitive. So that gives a boost to our economy. And it also helps when you're investing overseas. So I think that could be a tailwind for international equities going forward. A couple more here, and then we'll move on to the next segment. But housing market is on fire. This is a December 14th number, but 30-year fixed mortgage was 2.85 on average. I actually think it's down to 2.75. So if you haven't bought a house or you haven't refinanced your mortgage, you're going to miss out on maybe one of the more golden opportunities. And then finally, credit spreads look good, and I think credit spreads are moving up or widening. That would be a sign that the credit markets are concerned the economy is weakening or slowing down, and we just really haven't seen that really since the peak in March. We've seen it come down. We have a couple little blips here along the way, but the trend has definitely been lower. We're going to get to a point where we're going to push the envelope here, and they won't get much lower. They're going to get back to historical levels. But I think it's another great sign. So not only do the equity markets indicate that the economy is doing well, but so do the credit markets as well. And then finally, a couple other things here, but the central banks, I don't think they're going to raise rates at all. One of our themes for the year was the Fed was going to be on hold for the year. They have indicated numerous times that they have no intentions on raising rates. I know that's hard to predict, 12 to 24 months down the road, but I think they are committed to that. I think something drastically would have to happen in a positive sense where the economy was just running way too hot for them to even consider that. And I don't think we'll see that this year, at least on the short end of the curve. So I think overall, the risk is to the upside here. I know I think a pretty positive view of the economy, but I think we have $600 checks being distributed currently. The incoming administration, President-elect Biden's ran down in the Georgia Senate races. He was down there saying that they would get $2,000 checks. So I think it's something he's going to deliver on soon in his administration. So that's going to be another $1,400 that's going right to the consumer's pocket, which we mentioned earlier as a driving force of the economy, and they're going to go out and spend those dollars. So I think it's going to be at least from a short-term standpoint, it's going to be a big boost in the first quarter. This is Evercore ISI's economic outlook, and as you can see, they have 10% GDP growth in the first quarter, followed by another 10% in the second quarter, and then it fades a little bit as you get into the second half of the year. But as the economy goes, so we should see a bump in corporate earnings, and that'll be good for the markets going forward. So I'll pause there as far as the economy, and then we can jump into the markets, Emily. But any questions at this point, or?
Well, we do have one that was asked about interest rates being, do you see any uptick this year? And based on what you just said, you're thinking they're going to stay relatively low?
So I think there's two parts to that. One is the short end of the curve, which is basically money markets, T-bills, savings accounts, CD rates, those type of things. And I think, I think the Federal Reserve is not going to raise the short end of the curve, which is the Fed funds rate. It's at 0. It's going to stay there. So I don't think you're going to see a big jump up or improvement in savings accounts. I think money markets now are paying a few bips. I don't know how much that'll change over the course of the next 12 months. I think on the longer end of the curve, you will see it steepen somewhat. And we have seen that. I'll show a chart here in a minute. But the 10-year Treasury, I think, is at 115 today, which doesn't sound very high, but I think it was at 50 or 60 basis points probably 3 or 4 months ago. Right. So it's definitely, it's doubled, although from a very low base, but it has doubled. So I think, we could see a steepening of the curve. I'll show a chart a little bit later as far as kind of the range we think it could go. But, one of the things we did mention, and I'll touch on in a second here, is, we think rates will drift higher on the 10-year. But as far as the Fed's raising rates on the short end of the curve, I don't think that's likely this year.
Okay, one other question before you go on relates to who we think winners and losers are in the next 60, 90, 100, 180 days. And do you think that the recent news on some of the social media sites eliminating Trump from their site, is that going to have an impact on any of those particular stocks?
So, I'll answer that. I'll actually answer two of the questions. I think one was about the political conversation and does that have anything to do with markets, and then specifically to the one with the social media. We've been a believer, and I think it's panned out over the years, that at the end of the day, politics don't really control much of the direction of markets. I mean, we've talked about it's not really relevant if Republicans or Democrats win over the long term. I think from a headline risk in the short term, you can see those things, and it does have some fluctuations on daily. There could be an issue where maybe a few social media companies might get dinged, but overall, I don't think politics really affect the markets. I think if anything, tax rates and trade policy probably have some impact on markets. Definitely have impact on markets, but the daily gyrations of the political arena don't really have that much long-term effect, I think, on the markets. Now, that being said, with specifically to the question about winners and losers, I don't think it's going to have a big effect on those tech titans, the Facebooks and the Googles, Apples of the world. I could be wrong on that one, and time will tell. But if you go back a few years, Facebook had a big issue with privacy. And I think it was in the news every day. Stock did take a hit in the short term, but in the long term, it bounced right back. But in the bigger picture of things, their daily average users, which is really how they sell advertisements, never really went down. In fact, it's higher now than it was 2 years ago. So I don't know if there's going to be any long-lasting effects. We could see some headline issues here and there, but I don't think we're really going to see companies fold because of those type of things. So.
Okay,
So
I've got a few more questions here. If you just bear with
yeah,
me, I'm just
sure.
um, with interest rates seeming to rise and inflation increasing, what is your view? Bear with me.
Mhm.
What is your view of bonds, fixed income? Should we scale these back? And maybe you're going to address that in the next.
So I'll probably touch a little bit on that. So I think, well, I guess inflation's a good question. Which what direction is inflation heading? Currently it's below 2%. The Federal Reserve has indicated as part of their interest rate policies over the next few months or next few years. As I mentioned, they're not going to raise the short-term interest rates, but they are keeping an eye on inflation. And history would tell you they like to see inflation around 2%, but they're willing to let it run hot, as they say, which I think means a little higher than 2% and for a little bit longer before they react to it. So we could see some inflation in the second half of the year, and I'll touch on that later on. But as far as interest rates go, as far as yields go, I should say, especially on bonds, it's a tough environment out there. I mean, the yields are not very high. I think globally speaking, our rate better than most, but still not very high. Um, I think we've looked for other ways to kind of scale back or look for bond alternatives. And I think if a client has a question, they can talk to their advisor and we can set up a call to do that. But I think it's going to be a muted return in fixed income, at least in the short term here, next 12 to 18 months. But moving wholesale out of bonds, does have certain risk issues to it. I think when you do see declines in the markets on the equity side, bonds do serve that ballast of the portfolio. So I think wholehearted move out of bonds and doubling down on equities is probably not the best decision either. So I think the easiest answer for me to give is have a discussion with your advisor, and we can tailor that specifically to your portfolio. But I do think we're going to see some muted returns over the next, I'll use the next 12 to 18 months on bonds. But I will tell you, predicting the direction of bond rates, yields, has been exercise in ability, as I mentioned a few times. So we'll see how that goes.
Well, I'm gonna give you one more before you move on because it relates back to the economy. Can you describe why you think the recovery will be V-shaped rather than a K-shape?
Well, I guess I would argue why so far the data has indicated that it is, it's been a V-shaped recovery. So I'm just following the data. I don't have a letter in the race, so to speak, a K, a U, a V. I'm gonna try to react to what we see. And so far the data has been stronger. I mean, we saw, I don't want to bore people, but I could put up 25 of those pictures and they all look the same. The market looks like a V, retail sales is a V. I could rattle off the list. So, I'm just looking at the data, and so far to me, that's what it looks like. Could it change? It could. There's a lot of things out there that could derail our theory, our thesis this year, which is an improving economy, mass distribution of vaccines, some type of reopening in the second half of the year. I won't say we get back to normal, but some type of return to normalcy. That's kind of the base case, but it could be derailed, and then maybe we're talking different letters and different shapes of the economy. So far, the data looks pretty consistent.
Okay, I'm gonna let you move on. The questions are coming in, but we'll save some for later.
Okay, sounds good. All right, so to kind of continue the theme, I probably just touched on a few of these as Emily and I were talking, but I think market themes for 2021. We expect further gains in the equity market as the economy ramps up, and again, that kind of all ties back to an expansion of the economy due to the reopening of the economy. So earnings growth will likely fuel the market advance. As far as valuations go, I think last year was mainly driven by multiple expansion. I think this year we'll see maybe a little more, some multiple contraction, but most of the driving force of the markets will be from earnings growth. We did talk about yields a little. The 10-year yield, our prediction will probably break above 125. We're kind of in that range of which we broke above, and then 144, which I think is the next real level of resistance. So we're kind of in that area right now. Cyclical sectors will continue to be leadership over defensives. Small caps will likely outperform again this year, and as I mentioned in the I guess the first slide there with the periodic table of returns, you know, small caps did come on last year, and so far they have continued that, and we'll talk about that in a second. And then finally, you know, we're going to see corrections. We're going to see consolidations throughout the year. As I mentioned, last year we saw 4 of them, the biggest obviously being in March, and I would expect not as big a decline, but I think we'll see some declines and some pullbacks along the way. And I think at the end of the day, you know, buying the dips will prove to be beneficial. So you know, equity market advance has been broad and expanding. This is the value line index. I know there's a lot of talk during the run up last year and over the last year or two that it's really been driven by 4 or 5 large tech companies like Facebook and Amazon and Google and Apple, and you know, that may be true, but if you look at the average stock, it continues to outperform. So this is the value line index. This takes 1,700 stocks in the US and it equates them. So it's not just the Apples of the world. It's a pretty broad group, and it's actually been doing better than the S&P. So on a relative basis, back from March, it's been pretty consistently growing, which is kind of same as the small cap story to a certain extent. So it's not just 4 or 5 stocks driving the market. It's been pretty broad-based recovery in the equity markets, and I think we'll see that continue over the next few quarters. You know, there's a lot of reasons to think that the market can move higher. I mentioned a few of them already, but the vaccine, the dollar, monetary stimulus is still being pumped into the system, and we think we'll see another one of those once the Biden administration comes in. I think we're going to see less turbulence. But really, the one I'm looking at the bottom there, the S&P has rallied significantly in the first year of the past 3 presidential terms. So the first 2 terms of the 2 terms of Obama and then the first term of Trump, we've seen markets rally in that first year of the presidential cycle, which tends to be a positive year. The third year historically has been the best, but the first year is the second best, and over the last few terms, it's actually done better. So not a lot of data points there, but we're hoping that trend continues in the first year of the Biden administration. You know, second, a lot of money is still on the sidelines. You know, we saw the blue line here is retail money market funds, and then the red dotted line is institutional. But you know, as we came into the year, especially as this is March, so we had the drawdown in March, a lot of money moved to the sidelines. It's not all come back, but you're starting to see it slowly come back into the market, and I think we'll see that trend continue. There's a certain fear of missing out or FOMO mentality that kicks in here. So again, building off that theme, you know, we came off the bottom in March. For the first 3 months, you didn't see much change at all, and then we've seen a pickup in equities, which is this blue line. So people have started returning them to the market, really picked up near the end, the last few months of the year here, basically the last quarter. I don't know if we'll see it continue at that rate, but I think we'll continue to see money flow into the equity markets. So we touched on this already, but 10-year Treasury, you know, we're currently at actually 115. I can't write these things quick enough because it moves too fast. So it was 115, I think, as of yesterday. We're kind of in this range here. You know, the next level of resistance we see is probably that 144. So, you know, where rates go exactly, I don't know. I think, you know, they can get up to 2% before they really have an impact on the economy, and I don't know if we'll get there this year. But as I said, it's been an exercise in futility trying to predict which way the markets or which way the yields will go. But if I had to pick a direction, I think we'll grind slowly and higher over the course of the year. One of the interesting things is, you know, you kind of want to yin when everybody else yangs on these things and predict, as I mentioned, got ahead of myself, is predicting direction of rates is an exercise in futility. And this is a chart from Strategic Research, but they went out and asked, they didn't go out and ask, but there's 54 analysts out there that give a prediction on which way they think rates will go. and only 4 thought rates would be higher than 150 in the 10-year. So if you're looking for a contrarian direction, that would be it. Most think it's going to be somewhere, around the, 1 to 1.5%. But the dark horse would be that the rates move up above 150, which is a little more aggressive than we would think. Within equity markets, as I showed at the beginning of the presentation, that emerging markets outperformed domestic markets here in the U.S. The large cap equities came in right behind small cap equities. But we think there's 2 big bases being formed here. This goes all the way back to 2007 highs prior to the financial crisis. And although we've seen moves up here within the emerging markets, they have not broken above that. And I think, there's an old saying, the wider the base, the higher in space it goes. So I think if we see that break above, and I think we will, we're going to see emerging markets be one of the leading asset classes going forward in 2021. So before we get into the portfolio specifically, Emily, I'll pause there. I know you said you had a couple more questions rolling in.
Yeah, I do. And I should say that one of them, it relates to what we think of tax rates going forward, what the Biden administration might do, whether they will eliminate the Trump tax program. And before you answer it, I will say that I think we've got some plans to put out some more commentary on this and later in the month. So, if you have any thoughts on taxes and how that might impact the markets?
I don't. So we get a lot of policy research from different places, and I'll tell you what I'm seeing. I don't really have an opinion as far as taxes go, but it seems like because of the tight nature of the breakdown in the Senate, and there's a few, and there's not many moderates anymore, but there's a few moderate Democrats. I think Senator Manchin out of West Virginia has been mentioned a few times. I don't think we're gonna see much in change as far as the rates this year. I don't think anything will be done retroactively, and I think the incoming administration is very aware that they don't want to do anything to derail the economy. But it sounds like if there's any consensus, we'll probably see some rise in corporate rates from 21 to maybe back to 28 or somewhere in that area. I think the SALT tax is another thing that people have been talking about. The Democrats are desperate to get rid of, so I think there's probably some support there. But I think you're going to see less than people expect. I think getting 50 votes in the Senate still is going to be tough. I think the House, there's only 4-seat majority. I think they have 222 votes, and you need 218 to pass something. So we'll see how it works. But I think from what I've seen, there'll be some things, but they have to pass it through reconciliation, which means you have to pay for it somehow in the out years, and I think it'll be a struggle. But my guess is you'll see some taxes get raised, probably not as many as were promised.
Okay, one more question. What do you think about the effect of microchip shortage on market segments?
Microchip shortage? Honestly, I don't have much of an opinion on that one. I'd have to look a little bit more into it. I know there is a shortage on microchips. I've seen that in a couple articles, but I have to do a little more research on that.
Okay.
All right.
I'll let you go forward.
Okay. All right. So portfolios. As I mentioned in one of our themes earlier, we still like the cyclical areas of the market. We have been overweight cyclicals just because we think you want to be overweight the areas that are beneficial to a growing economy. So this is kind of where we finished the year. We're overweight technology, materials, and consumer discretionary, all cyclicals. If there's area we've been looking to bump up, and I said this before, but we haven't found what we like yet, would be industrials. But we continue to be underweight on the defenses, which is basically consumer staples and utilities. I think energy is something interesting. We've been underweight. That helped us quite a bit last year from a relative standpoint versus the S&P. I think that's one area that might be oversold, and an area we might look to add to as we go forward. it's done very well over the last month or two. I'm not sure that's a trend change or just a short-term blip, but something we're keeping an eye on going into 2021. So as I mentioned earlier, small caps have broken out. I think they've definitely created a tailwind in our portfolios. They've been a headwind for the last few years. We have an allocation of small caps. They've underperformed the market over the last few years. We've seen that trend change in the second half of last year. We think it has legs and probably will carry forward. History would tell you they tend to outperform coming out of recessions or at the end of bear markets. So, that's kind of where we saw this happen. So right on cue, they have been outperforming. Most likely we see some corrections or pullbacks along the way, consolidations, but we think that trend likely will continue into 2021. Just to kind of I actually looked up this morning, year-to-date small caps are up 6.3%. That's only, 6 trading days. And the S&P is up 1.3%. So they've outperformed by 5% already year-to-date. So so far in 2021, that trend has continued. So history would tell you that markets, should have a positive year. If you look at the last 2 years or last 2 months of the year, November, December, where we saw a good bit of the returns for the year, 14.3% in the month of November and December. History would tell you that tends to be a good January. That's happened 5 other times. You get a good January, and you tend to get a good follow-through year. So another reason I think we have a little bit of a tailwind behind us going forward. So I got a couple of things at the end here, Emily, just kind of we're watching going forward. We've probably touched on a few of them, but I'll pause there. Any other questions you want to kind of clean up before we head into the last segment?
I'm going to give you one more, John, related to inflation. What are some of the U.S. dollar inflation factors in 2021? Any forecasts there?
So inflation, I think. So I think big picture, I think we're going to see a little bit of inflation pick up. Inventories are rising low, so demand is going to start to outstrip supply here pretty soon. So just big picture, I think we will see some inflation probably in the second half of or maybe the middle part of the year. I listened to a guy named Jeffrey Gundlach yesterday on CNBC. They call him the Bond King. He is well versed in these things, and his opinion is we're going to see a 2-handle on inflation pretty soon, meaning 2% or more, and probably could get up close to 3% by the sometime in the middle of this year to the second half of the year. Commodity prices overall aren't too bad. I think oil's up to $50 or maybe $60 now. I think if we get oil up to 75 to 80, I think we're going to start to see year-over-year numbers look pretty big as far as the increasing gasoline prices, and that tends to have a trickle-down effect or a ripple effect within the economy. So that's something we're looking at, but I don't think it's a big issue yet. So I don't disagree that inflation could rear its ugly head sometime this year, probably in the second half of the year. I don't think it'll be as high as it won't be high enough to warrant the Fed to change their policies, is my guess. But further you get out on those things, a little harder it is to predict. So we're actually going to keep an eye. I actually have a slide on that in the last bit of the last segment here. So
okay, I think you're
Anything
good
else?
to go.
All right. So couple things we're still looking at or watching. There's a lot of talk about value versus growth out there. We still lean towards growth. We have a growth overweight in our small mid-cap area, but we are looking for that reversal. This is a chart from Ned Davis, and it's a pretty busy chart, so I apologize for that. But these green shaded areas tend to be when growth outperforms value, and we've seen one of the longest, if not the longest, I guess, growth trends here, and they tend to call the reversal when they see a reversal. I think it's around 20% or more. So we haven't seen that yet. We've seen a little bit of value beating growth over the last month or two. I think that's not long enough to call a trend change, but it's something we're keeping an eye on. So far, I think growth still is still a growth market until proven otherwise, but I think we could be in the beginning of a trend change there. So Emily mentioned and asked a question about inflation, which stole a little bit of my thunder here, but inflation seems likely to appear sometime this year. But at this point, we're not too concerned. What's the best for the S&P as far as inflation, we're kind of this 1 to 2% camp right now, and inflation hasn't really affected the market returns when that happens. You get a 78% chance the markets are positive. You get to 2 to 3% of inflation, which we could see, as I mentioned, in the next few months or in the second half of the year. Same thing, returns tend to be pretty good overall anyway. So I think as long as we stay below that 3% threshold on inflation, which we're well below right now, I'm not too concerned, but it's something we're keeping an eye on. And then, the last few things here, expect consolidations, but I think are corrections, but either way, you probably want to buy the dip. Again, this is a Ned Davis chart. They tend to have very busy looking charts, but these movements here are how long it's been since the last correction. So it's been 48 days since the last 5% correction, almost 200 days since 10%, and then 20%, which would have been back in March. So history would tell you when you're in a secular bull market, which we are, it's about every 200 and some, if I can read it right, 331 days. So, we're going to see them. History would tell you we see at least 1 to 10% correction a year. And I think, our theory would be, and we would advocate this in portfolios, is, you want to buy those dips when you see them. Again, in an expanding economic market or expanding economy, I don't think they're to be feared. So I hope this is my last political slide until the midterms. I know we've talked about politics quite a bit, but this is how the Dow Jones has performed since the Second World War, when Democrats controlled both both houses of Congress and the White House. I think there's 10 here if I counted them correctly. We've seen 2 times it was negative, so 80% of the time the markets tend to be positive, and the average is about 15%. Not something I lose too much sleep over, but I know people tend to want to see how politics relate. And I guess, last slide, the moral of the story for 2020 was stay focused on the long term and stay invested. So this gray line here is the S&P. The reddish line there is if you missed the best 2 days of the year. I think we had one year the market was up over 10%, so you'd have been down 4%. If you missed the 10 best days, you'd be down 35%. So, timing the market's always tough to do. It's one of the reasons why we always advocate, talk to your advisor, get with a S allocation that the risk reward is something you're comfortable with, and then stay invested over the time frame. So that's it. We'll open up the questions if you have any, other than the ones we already got. That's Rick D'Amico in the lower right there. He's the head of our fixed income and alternative investments. So if you have questions on rates or yields, he's probably a better person to answer the questions than I am, and he'd be happy to jump on a call with you. Anything else, Emily?
Well, we did get one more related to market timing, and when you mentioned buying the dips, but isn't that market timing?
Well, I think at the end of the day, we're fully invested. So if we have a 65% equity allocation, we're somewhere close to that. If the markets would go down, and you can't move, market's going to move every day, so your allocation is going to go from 65 to 64 to 66 to 63. So I think if we see a 10% decline in the markets and your equity goes from 65 down to 62, when I say buy the dip, I would be advocating just to kind of bump that back up to 65. Just not really moving out of the market or moving back, changing your allocation. It's really just rebalancing it back to where you were and taking advantage of the drawdown. I guess if that's a little more clarity to it.
Okay, we just got another question. Thank you for these questions. It's been great. Any thoughts on blockchain stocks, ETFs, specific assets? Thoughts on decentralized financial movement? I hope you understand that one.
So blockchain, crypto is probably what they're talking about, I'm guessing, Bitcoin. So that's kind of so I don't have an opinion on Bitcoin, I guess is maybe the easiest way to say it, because that's probably what the questioner is getting at. Much like gold, I think people are looking at Bitcoin as a hedge to inflation. It's not tied to the point. It's not tied to the financial markets. It's not tied to one sovereign government. It's kind of a asset without borders, I guess you could call it. I don't really have an opinion necessarily on that. I think if clients really want to buy a position in Bitcoin, as a hedge to their portfolio, I think that's fine. We could probably help them do that. It's not something we keep a close eye on. Really kind of goes back to the point. There's no yield to it. There's no income to it. There's no dividend to it. There's no earnings tied to it. So for us, we want to have some type of valuation on why we're buying something, and that one just kind of makes it difficult. I think you're hedging your bet for what you think is some move away from currencies or inflation or hedging some political risk out there that for us is hard to put a valuation on. So we tend to avoid that. But again, if it's something you want to add to your portfolio, we can have a discussion and help you do that.
Great, thanks. So I think that covers all of our questions. If we didn't get to yours, either your advisor or somebody from the investment team will reach out to you directly. We appreciate your joining us today. It's always a privilege to inspire you and your families, and we sincerely thank you for your trust and loyalty. I hope you have a wonderful day.
Goodbye. Thank you.